I want to welcome you here on behalf of the Law Society to our program, GST and Your Law Practice. We're delighted with the turnout today, and thank you all for coming. It's my pleasure to introduce to you the chair for today, Mr. Blake Murray, who is a partner at that Toronto law firm that we all know and love, Osler, Hoskin and Harcourt. Blake was called to the bar in 1975, and he specializes in tax matters in his practice. More particularly, he has been acting as general counsel to the Standing Committee of the House of Commons on Finance and Economic Affairs with respect to the public hearings on the proposed goods and services tax and the subsequent review of Bill C-62. So he's eminently qualified to put this program together, which he's done. We have two other speakers today, Irene David and Tom Akin, both of whom you'll be hearing more about from Blake later on as the day gets underway. So I'd like to have you join with me to welcome Blake and Irene and Tom for what I know will be a very informative morning. Thank you very much.
Good morning. It's a pleasure to be here, and to say my chief qualification for today's program is my personal friendship with Irene David and Tom Akin, who have prepared the paper, so this is a fairly easy effort on my part. Before we begin the substantive part of the program, I thought I might make some general comments about concepts in the goods and services tax, which you may find useful in putting the balance of the program in context. Probably the most important word in the goods and services tax is the input and the input tax credit. Now, an input is something that you buy, property or services that you buy for use in the case of a law firm in performing your services. So you have inputs go in, like raw materials, and on the other side, you have your output, but they don't use that term, they use consideration for a supply. So you acquire property and services in your law practice, and in turn you supply legal services. So you have an input in and a supply on the way out. There is a concept of an input tax credit which allows you to claim back the taxes that you have to pay on inputs used in your law practice. And that is done through the input tax credit mechanism. On the other hand, you must collect tax on the supply of legal services that you make, and the difference between the tax that you charge on your services and the input tax credit is your net tax, and you're required to remit that amount with your GST return for the reporting period. And the reporting period will vary depending upon the size of the law practice, meaning the dollar sales or dollar volume of the law practice in a year. And I won't get into the standards for that. Just by way of general comments on the status of the goods and services tax, as you all know, it's now been passed by the House of Commons and is currently in the Senate. It received first reading in the Senate on April 11th and has received second reading on May 3rd of 1990. It's currently under review by the Senate Banking Committee, who have indicated that they intend to deal with it sometime around October of the fall, and in the interim are holding hearings on Bill C-62, and it's still possible to make representations to the Senate Banking Committee. Again then, just as a brief conceptual background, the GST is a tax at 7% of the value of the consideration paid or payable by a purchaser of a taxable supply of property or services. The tax is imposed on the purchaser but is collected by the vendor as agent of the Crown, and the tax liability generally arises on the earlier of the day the consideration is paid or becomes due, subject to some special rules. Now, in general, there are taxable supplies and there are exempt supplies. Without straying into the papers, I'll just say that those are the two general categories of supplies under the goods and services tax. Taxable supplies are generally taxed at 7% unless they are zero rated, which that concept is one that's used in the case of services for the most part for the export of services, which would mean the supply of services generally to a non-resident or in connection with an export. In the case of goods, zero-rated goods are usually confined to things like basic groceries, medical devices, and prescription drugs. So taxable supplies divide into two categories: those that are taxed 7%, which is the general category, and those that are taxed at a zero rate. The other, in either case, whether the goods or services are taxed at 7% or at zero, there is a full input tax credit recovery. So the issue on a taxable supply is not the ability to get back the input tax credit, it's the level of tax that's payable by a purchaser of those goods or services. There is another category of supplies known as exempt supplies, and in the case of exempt supplies, there is no ability to get back an input tax credit. So that on an exempt supply of goods or services, no tax is charged on the supply by the supplier, but the supplier cannot get back an input tax credit. And I guess the best example of that is a financial institution rendering financial services. It will charge no tax on the financial service. So, for example, interest on a loan is not taxed, but there is no ability of a financial institution to claim an input tax credit on the goods and services that it purchases for its use in making a supply of financial services. With that in mind, then, I'm going to turn the proceedings over to to Tom Akin of McCarthy Tetro. Tom is senior partner in the tax group of McCarthy Tetro here in Toronto and eminently qualified to speak to us today on the GST and legal services. He is the current chairman of the Commodity Tax Committee of the Canadian Bar Association and has participated in a wide range of seminars and submissions to government committees. So I'd like to ask you to welcome Tom Akin this morning, who will address the topic of GST and the law practice.
Thanks, Blake. You have my paper in your materials. I'm going to speak to several points made in the paper. I will not follow the order of the paper, but I will refer you to the pages during my discussion. You also have some case studies, which I will defer until after Irene speaks regarding the systems implications and accounting issues. There are also some questions that we received that we will deal with at the same time as we deal with your questions. Now, I just want to forewarn you, there are a few editing errors in the paper. They're not major and they're not numerous, but I will point them out when we get there. WordPerfect is wonderful, but sometimes when you're matching various versions of drafts, things get left out. And occasionally some passages get missed or some changes don't get incorporated that should have gotten incorporated, and I will highlight those. And as I say, they're not major. One of them deals with an issue that I'm sure will lead to quite a bit of discussion. Having said that, Blake has given you a basic overview of the GST, and a lot of the terms are essential to understand. But basically, the basic proposition for lawyers in private practice is that their legal services will now be taxable under the GST, and that means that you will add to your legal bills As a general rule, there are some exceptions, and we'll talk about those, but as a general rule, you will add to your bills for services 7% tax starting January 1, 1991. Now, as Blake was saying, that's the case for taxable services. We'll talk in a minute about some services that may be zero-rated. They're taxable but at a zero rate, and that has certain implications for your practice. And by and large, some of you may be involved in providing exempt services, but those are going to be rare, and we'll get to those and the significance of the distinctions. As I was saying, as a general rule, all of your legal services will be taxable. That will include legal aid. And you may have noticed some discussion on legal aid. Blake and I were shared membership of a committee for some time, for several years, that has been working with the Department of Finance and with the Canadian Bar and with the legal aid societies in order to obtain what we thought would be equitable treatment for legal aid. And it underwent several changes, finally at the Blanchard Committee stage. The result being that legal aid is taxable. Now, a lot of you are going to say, well, gee, why would you want legal aid to be taxable? And the reason is because if legal aid had been exempt, any of you providing legal aid services would have had the difficulty of trying to determine which of your input taxes you pay on rent, etc., and I'm going to come to that in some detail, which of those are allocable to legal aid as opposed to the rest of your practice. Because you're denied an input credit when you're to the extent it's allocable to an exempt service. So while exempt sounds good because there's no tax, it's bad for the person providing the service because he or she must now segregate as between their various inputs, which are allocable, and Irene will talk about allocation issues to the extent you're going to have to deal with them, and there are any number of ways to approach it, and it's not necessarily an easy task. The long and short of it in the case of legal aid is that it is taxable, so that's good for lawyers. Sounds bad for legal aid plans. However, they are eligible under Section 258 for a full rebate of any GST paid. So legal aid will not bear GST on lawyers' services as a result. Why go to all that trouble? Why not just zero rate? Well, that was a design and political issue. A lot of you may have noticed debate and discussion over what should be taxed and what should be zero rated. And a lot of sectors are pushing for zero rating rather than taxing with a rebate. And politically, the government was reluctant to set a precedent in the zero rating area. As you may be aware, only a few goods and services are zero rated, such as basic groceries, and the government wanted to keep that to a minimum. The solution was to tax legal aid, so you'll add GST to your bill, to the legal aid plan. The legal aid plan will get a full rebate. Now, the one exception is legal services provided by the legal aid plan itself through staff lawyers. That has been made exempt, so there's no tax on that because those bills go to the consumer. However, the legal aid plan is not entitled to claim an input credit, so legal aid plans will be subject to some cost as a result of the GST. Now, I've taken a little time to talk about legal aid, and if anyone has questions when we get to the question session, by all means fire away, but it is an area that was of great concern to the practice all across Canada. Now, at this point, I'd like to move to the area that may be zero rated, and those are exported services. It's an exception to the general rule of what's taxable. As I was saying, most of your, it'll be quite simple for you. In most cases, you'll simply add 7% GST to your bills. In the case of an exported service, and we're going to talk in a minute about what that might be, that you would not add GST to your bill. Because exports are zero rated, and the impact of that is that you don't collect GST, but you don't have to worry about your inputs either. They're treated the same way as inputs for taxable services, so you don't have to allocate between them like you would if it were exempt as opposed to zero rated. Now, exports are discussed on page 7 and 8 of my paper, and it's important to look at the listing there. When can a service be exported? In the case of a good, it's relatively simple. Either the good leaves Canada or it doesn't. In the case of services, and this too is an area where change has occurred until we get to the final rule, I've set out Section 7 of Part 5 of Schedule 6. Schedule 6 contains zero-rated supplies, and included in Schedule 6 are things like basic groceries, which don't concern us in a law practice, but also included is a category for exports. And a lot of the provisions are not relevant to us in our practices of law. However, Section 7 is very relevant. And the basic proposition is set out in the lead-in to paragraphs A through E. And the point is that when you're dealing with, in paragraph, the lead-in sets out the basic rule as to what is zero-rated. If you fall within any of A to E, then you're excluded from that zero rating. Now, you may find another rule that zero rates you, but the object is to try to fit within this rule whenever you're dealing with a non-resident. Now, the basic rule, as you'll see on page 7, is that a supply of a service made to a particular non-resident, and the other than an individual. The qualification is where the client is an individual, they must be outside of Canada throughout the period during which you're providing that service. So in the case of individuals, it's a slight complication. You must know, as a matter of fact, their physical location. So as long as they're outside Canada throughout the time you provide that service, in the case of an individual, it'll be zero rated. In the case of anyone else, for example, a corporate client, as long as they are a non-resident, then you're zero rated because in all likelihood you are providing an advisory, consulting, or professional service. And you'll see in paragraph A, there's an exception where the service is primarily for the consumption, use, or enjoyment in Canada. That would be a very difficult test for professionals to apply, so the words in parentheses takes us out of that test. So we're not concerned with where the service is consumed. As long as the person is a non-resident, if it's a corporation, or if it's an individual, they're outside Canada throughout the period, then it's zero rated. Now, I want to turn your attention, though, to the top of page 8, and you'll see paragraphs B and C, and as well as D. They are very important exceptions. If you fall within any one of them, then you will be...
This is that's on 6 on their page.
I see.
Use my paper.
Okay. My apologies. I guess I'm a copy behind or a copy ahead in the paper. I don't know which. It's on my page 7. Blake is good enough to hand me the copy that you have, and it's on pages 5 and 6. It's the way to get off to a great start. We're talking about different pages. You'll see that bottom of page 5 is a reference to section 7 that I was talking about, supply of a service made to a particular non-resident person. Top of page 6 is where paragraphs B, C, and D fall, which are the important provisions to take note of. First of all, a service in respect of real property situated in Canada. So if you're giving advice to a non-resident regarding real property in Canada, that is not zero rated, it's taxable. Secondly, a service in respect of tangible personal property that is ordinarily situated in Canada or that is to be delivered in Canada. An example, someone in the United States, long-standing client, contacts you regarding a supply contract they're about to enter into with a Canadian customer. That contract involves the supply of goods over a long period of time. It's likely that that advice would fall within paragraph C. A service in respect of tangible personal property that is to be delivered in Canada. Consequently, it would be taxable, notwithstanding that your client is a non-resident, so you must collect GST. Finally, a service of acting as an agent of the non-resident individual or particular person. So if what you're doing is an agent, in that capacity as an agent, and sometimes it's not easy to make a determination as to when you're an agent and when you're not, again, you would fall in paragraph C. Now, in concept, these rules are relatively straightforward, but in practice, you're going to have to make the decision when dealing with non-residents as to the type of service that's involved, whether the individual is a non-resident, individual or person is a non-resident, and in the case of an individual, where that person is during the time you provide the service, in order to conclude that it's zero rated and thus you need not add GST to your bill. That has certain systems implications, and Irene may comment on that, because obviously your systems have to know when to add GST and when not to. Now, as Blake was saying, the basic system under GST is that the consumer is the one that finally pays. Business collects, but consumers pay. It's multi-stage. And to illustrate this, I'll refer you to the chart on page 10. By coincidence, it's also page 10 of my paper too, so maybe we're going to be back in luck. You'll see I've listed a few things there, and I'm going to come in some detail in a few minutes to the kinds of inputs that may be studied to tax. But that chart is designed to sort of illustrate the payment of tax and collection of tax by a law firm, which is carrying on business. You'll see rent and supplies are consumed by the firm. $10,000 for rent, $30,000 for supplies. That totals $40,000, and so that's the $40,000 figure in the light shading in the third line beside law firm. Law firm has billings of $100,000, and you'll see that at 7% tax, that's $7,000 that would be added to the law firm's bills. And input credit is $2,800. That's simply obtained by aggregating the taxes paid on the rent and the supplies. And the difference is what is remitted to the government. Why only the difference? Because the government is entitled only to 7% of $100,000 as tax. It has already collected $2,800 of that in collecting it from you as a lawyer in acquiring supplies, taxable supplies, in order to provide a taxable service. So of the $7,000 you collect from the consumer, you reimburse yourself for the $2,800. That's already been paid as tax, and by remitting only $4,200, then at that point the government has collected 7% of $100,000, the final selling price of the legal services. Now the next line or column is relevant only where you have a business as a consumer or client. If you have an individual as a client, for example, preparing a will for an individual, then you would stop right there. The individual would bear the tax and not obtain any input credit. If, however, your client is a business, whether it's an individual or a corporation or whatever, then it too, it would pay 7% tax on the $100,000 of legal services, which it would then claim as an input credit. And if its total sales were $200,000, then it would collect $14,000, but it would only remit 7 because it's already paid 7. So as you can see, the GST being in its multi-stage feature, tax is collected along the way, and thus the reason for input credits, in order to give credit for taxes already paid. And so we as lawyers, as part of this chain, are involved in the collection process. We're not going to pay the tax. We're just paying, in effect, installments towards what our client is finally going to pay. And our business clients don't really pay the tax. It's the consumer where the tax finally rests. Now, other clients that will be in a position where they will not necessarily claim input credits are charities and nonprofit organizations. They're really in the same circumstance, although charities and some nonprofit organizations will qualify for a rebate of 50% of the tax they pay. Another group is commonly called the MUSH sector: municipalities, universities, schools, and hospitals. They too will be required to pay tax on your legal services, so you will collect it. They will be eligible for a rebate, the amounts of which have yet to be determined. They're being determined in discussions with the government. They may be, or probably will be, considerably higher than the 50%. Now, it's important to appreciate that as long as you can add 7% to your bill, then there's no financial detriment to you and your practice. Now, the odds of there being pressure for you not to add the tax are greatest when you've got clients that cannot claim input credits or can only partially claim input credits through a rebate mechanism in effect. So your individual clients, area of personal services, that's the area of risk. The real cost of that's going to go up 7% to the consumers of those services, and to the extent that that has an effect on demand, lawyers may be under pressure to share part of the burden. Where you're dealing with businesses as clients, however, or with non-residents, when you don't have to collect the tax, then the application of the tax, other than the compliance issues and the cost of complying, should not impose any burden for lawyers from a financial perspective. It should not have any impact on what we charge in our fees. Now, I want to turn back to pages 8 and 9, and there you'll see I've listed some of the typical, on the bottom of page 8, some of the typical input costs that you're going to be paying GST on. Office rent, for example, computer equipment, office furniture, office supplies, fees to independent contractors, and you'll see when we get to one of the case studies, for example, if you engage a witness. Continuing education, it's likely when you attend programs such as this, GST will be added to the registration fee, even if you don't feel there's any value added. Accounting fees, again, we know value is added there, so that'll be worthwhile. Utilities, telephone, leasehold improvements, maintenance and repair, subscription to journals, management company fees, seminars, all of those things will become subject to GST. And you'll have to keep track of the tax paid on all of those things so you can claim your input credits. And Irene will be discussing some of those issues. Now, some of the items that, some of your expenses which are not subject to GST, the main ones are listed on the top of page 9. Salaries of associates, wages and salaries of support staff, insurance premiums, domestic financial services, interest payments, fees paid to maintain your professional status. Those will not be subject to GST, and so you'll have to distinguish those expenses from the expenses listed on page 8, because those on page 8 you'll have paid GST and you'll want to claim your input credit. Those on page 9 you won't be paying any GST, and so you won't be claiming any input credit. Now, the next topic I'm going to move to is the area of disbursements. And hopefully that's on page 28, but let's look. Yes, it is. Page 28 is where we discuss disbursements. Generally speaking, a lot of the expenses that you incur for which you'll seek reimbursement from your client, which you show as disbursements, many of those will be taxable. However, some of them will not. They will be exempt, depending upon their nature. Now, the basic rule under the GST is that whenever you seek reimbursement for expenses that you've incurred, those reimbursements are given the same character as the fee that you've charged. So if the fee is taxable, i.e. it's to a domestic client, then you would add tax to the reimbursement for the disbursement as well. That's the basic rule. There is an exception provided in Section 178 of the GST legislation, and the exception is where you incur the disbursement as an agent for your client. So if you incur as an agent then the character of the disbursement is not affected by the character of your bill. Rather, its initial character is preserved and it flows through. Now, why is that important? Well, it's important because there are certain expenses that you'll incur on behalf of your client which are not taxable. And if your client is an individual, they will prefer that that tax-exempt status be maintained so that they will not have to pay GST. Otherwise, if it's not incurred as an agent, but you simply add that to your bill as a reimbursement for one of the expenses you've incurred on your own account, then GST will be payable. Now, as I was saying, that's really mainly of interest for those that cannot claim an input credit. Individuals, you're doing a domestic house transaction, any of the expenses you incur, such as land transfer tax, which is not subject to GST, you should ensure that you pay that on behalf of your client as an agent. Now, I've listed on pages 30 and 31 the more common or usual disbursements which are exempt. And you'll see, for example, the first one, registering any property or filing any document in a property registration system. So typically in a real estate practice, if you pay the costs of that, it's important to do so in the name of your client as agent. Now, the word agent, legally speaking, as you appreciate, has a very particular meaning. The legislation doesn't give any guidance as to what it means when it uses the word agent, so we presume it's agent in the usual meaning to a lawyer. In the technical notes, an example is given of land transfer tax, and they refer to in the name of the client. So it would appear that how this will be administered is if you incur the expense in the name of your client, then it'll generally be accepted that you've incurred it as an agent for your client. And so a disbursement of $100, say you pay for registering a document at the land transfer or land titles office, you will not incur GST, and you'll seek reimbursement from your client for that $100, and you will not add GST. You need not add GST to it, as long as it's clear you incurred that as an agent for your client. On the other hand, if you do not incur it as an agent, but you simply pay it, and then you seek reimbursement, then it takes on the character of the rest of your fee, and if that's taxable, you add 7%, so you would charge the client $107, $100 plus 7% GST. So the client, his cost has gone up by the 7%. To take the third area where you incur a disbursement of $100, which is subject to GST, you'd pay $107. You'd bill your client $100 and add 7% GST for $107. And then it would be a wash as far as you are concerned. Now, the next area I'm going to talk about are the kinds of services that can be provided by lawyers, and we'll flip back to pages 16 and 17. See, under the heading non-legal services, basic proposition is that legal services are taxable. However, there may be services being provided by you as a lawyer which are not strictly categorized as legal services. Now, that has certain other implications vis-a-vis insurance, etc. But by and large, one has to determine the nature of the service being provided in order to determine whether you will collect GST from your clients. Now, the first one I've listed there is the area of mortgages. Many lawyers are retained to give advice in connection with mortgages, and sometimes that advice includes the arranging of the mortgage as well. And I don't have personal experience in this area, but I understand that many lawyers are quite actively involved in arranging mortgages. Now, there's an issue here as to just precisely what the nature of the service is. Where does the provision of professional advice as a lawyer stop and the provision of some sort of other advice or service start? And the reason why I mention that is that financial services are exempt. In Blake's opening remarks, he mentioned the example of a bank providing a loan. That is an exempt service, so no tax is collected, and no input credits are claimable in respect of the inputs allocable to that particular service. Financial service includes arranging for loans. However, specifically excluded from the definition of financial service are two important areas that, for lawyers. The first is the service of providing advice. Okay? Generally speaking, providing advice is taxable. More particularly for lawyers, a professional service provided by an accountant, actuary, lawyer, or notary in the course of a professional practice is also excluded from exempt financial services. So as long as you can fit your advice into either of those categories, it remains taxable. And you would add GST to your bill. However, if arranging mortgages was to be determined as something other than part of your professional practice and something other than providing advice, then the amount that you would charge for that would be exempt as a financial service. Now that could be good or that could be bad, depending upon who your client is. If your client is an individual purchasing a home, then the less tax he has to pay on your bill, the better. However, if your client is a business, then they'll want to pay tax on your bill, because when they do so, they'll get an input credit for all of your input costs. There'll be a flow-through. Because economically, if you don't charge GST, if it's an exempt service, but you pay GST on your inputs, you're going to increase your price in order to reimburse yourself for that. So economically, your fee will go up to take into account the denial of the input credit, but the consumer or purchaser of that service will not get an input credit, and consequently will have to remit more of what they collect at the same time. So that is not a desirable situation to be in. So the determination of whether a particular service is truly part of your professional service as a lawyer, or whether it's part of, if it's not, whether it's advice, can be an important one, and the answer you want is going to vary depending upon who your client is. Now, it's by no means clear that arranging mortgages, and I mentioned this to Blake and Irene before we came in, and one can get into different views as to just where you would categorize that service. And maybe we can discuss that more in question period. I do understand, however, though, that in the United Kingdom, which has a value-added tax, which is not all that different than this, GST, in many respects, that arranging of mortgages is dealt with very specifically so that it is treated as an exempt financial service. At the moment, we don't have much in the way of guidance, but you can see that the discussion on the paper on pages 16, 17, and ending on the top of 18 assumes that that service would be determined to be an exempt financial service. Now that's not an opinion, it's just an assumption for the purposes of making the point of what happens if you're providing an exempt financial service as well as taxable services. You could have an issue on input credits. Now, one of the editing errors in the paper is on page 17. That large paragraph neglects to incorporate a reference to section 185 of the legislation, and it's a very important provision. Section 185 deals with someone that is not a financial institution by definition, that is engaged in a commercial activity, such as a lawyer, providing taxable legal services, who also happens to provide some financial services. Section 185 says that providing the provision of those financial services, which are exempt, are related to your commercial activity, namely your practice of law, then this rule says you do not have to allocate your input credits. It doesn't change whether you're going to collect tax or not, but what it does do is relieves you from having to allocate your input credits, because it deems all input credits, whether allocable to that exempt financial service or not, to be part of your commercial activity. So it's a rule of general application, but it would also apply to lawyers that may be involved in providing an exempt financial service as part of that's related to their practice of law. Now, related, there's no guidance as to what that means. We do know that words like in respect of or in relation to, the courts have held to be words of very broad meaning, words of the widest possible import. So I suspect that most of you that get engaged in arranging of mortgages would be able to make a pretty good case that it's related to your practice, because it's very difficult to know when one starts and the other stops. Some transactions you won't be doing any arranging, you'll strictly be providing advice on the mortgage, and advice on the mortgage is clearly taxable. Other transactions, the main service you may provide is the arranging of the mortgage. Putting two people together, putting someone that needs money together with someone that has money to lend. So Section 185 is an important rule. It doesn't relieve you of the difficulty of determining whether you collect tax or not. It only deals with the input credits. And it says, all right, you don't have to allocate as long as it's related. Now, caveat, that provision applies only if you're not a financial institution. Now, financial institution is defined in Section 149, and a lot of the usual things are there: banks, trust companies, credit unions, etc. We're obviously not that. However, there is a rule that says that if a certain amount of your revenues, if your revenues from exempt financial services exceed a certain level, then you're considered to be a financial institution. Now, for our purposes, there's a couple rules, and I won't get into all of them because they're complex, but for our purposes, the main one of interest is the 10% threshold rule. If more than 10% of your revenues are from exempt financial services, then you are deemed a financial institution. And the result of which is you're denied the relief in Section 185. You must then allocate. So the discussion on page 17 neglects to discuss Section 185 and an exempt and the definition of financial institution. So keep that in mind. 10% threshold is not a very large one for certain practices, but I suspect that for most of you, you'll have little difficulty staying under the 10%. But for those of you, and in which case you don't have to worry about allocating inputs, but we still have the difficulty of deciding just what the nature of the service that is being provided and whether you must collect GST and charge GST. I'm sure there may be questions on this area, and as I say, there's not a lot of guidance at the present time as to just how we're going to categorize this. So during question period, if you have questions, then I'm happy to deal with them. Now, the next area of services which you may be rendering, which I've listed, is acting as a trustee. That's on page 18. And that is deemed to be a taxable supply or part of your commercial activity. And so that is taxable. So even though you're acting as a trustee, as opposed to providing legal services, any revenues for that, you'll have to collect GST. And thus, any inputs that are allocable to that are equally creditable like all other inputs, or most other inputs. The next area discussed is directorships. Taxable supply by definition includes office or employment. Being a director falls within the office or officer category, and consequently you'll not be required to collect and remit GST on any director's fees. By the same token, any costs incurred as a director which are not reimbursed, you'll not be entitled to claim an input credit for either, except where they're deductible from income taxes. So if you can claim a deduction for income tax purposes, then you'll get a credit for GST on your tax return. So as a general rule, directors' fees are not subject to tax. Now the next area I'm going to discuss is registration, and that starts on page 12. Now Irene is going to talk about registration, I believe, but I will just make a few points on this topic. Basically, who must register? Well, any of you that are sole practitioners, it's the sole practitioner lawyer that will register. However, if you're in partnership, it is the partnership that must register. The individual partner need not register. In fact, can't register unless you're engaged in some other activity. So it's the partnership that's treated as the person, and by definition, person includes partnership under the GST legislation. So it's similar in some ways to income tax, where you calculate your revenue and expenses at the partnership level, but for income tax purposes, you then allocate that to the partner, who then determines what tax is owing. Under GST, it's carried all the way through, and it's the partnership that will collect GST on the bills, and it's the partnership that will pay GST on the inputs, and it's the partnership that will calculate the difference and remit the difference. Now, on page 13, in the case of partners, I discuss what happens when partners or employees of the partnership are reimbursed expenses by the partnership. And the basic rule is that the tax paid by the employee or partner for which he's reimbursed is flowed through to the partnership. So the partnership would get an input credit on the reimbursement. Now, there's one area of difficulty here, and that is, and it's commonly referred to as the tax and tip problem. You could be incurring expenses. Many of you will incur expenses primarily in Ontario, but you could incur expenses all across Canada. And often you get a receipt, like a ChargeX or a MasterCard slip, or American Express, whatever, credit card slip. It will have the total on it, and it may have some statement that the price includes GST. There's some difficulty in determining just what portion of that was GST and what was not, because, for example, if the bill was $100 at a restaurant, GST is added to that. If there's a tip on top of that, there's no GST on the tip. So one has to determine just precisely what the GST part of it is. I'm not sure if Irene is going to talk about that during her presentation, but that is an area that is of some difficulty for compliance. Just how do you calculate precisely on a reimbursement what portion was GST and what was not? General rule in concept sounds pretty simple. You incur an expense, and if it's a simple example that you purchase a good for which you're being reimbursed, you pay $100 for it and you pay $7 GST, the partnership is entitled to claim the $7 as an input credit, not the partner, and not the employee. Now that's where you're reimbursed. If you're not reimbursed, but you're otherwise entitled to claim the cost as an expense for income tax purposes, and the example I give in the paper is entertaining clients at home. Practice varies among firms. Some partners seek reimbursement, some don't. Nevertheless, where they don't seek reimbursement, they claim as an expense, a legitimate expense, on their income taxes. To the extent you pay GST and you're entitled to an income tax deduction, you're entitled to a rebate of the GST, which you would get at the time presumably you file your tax return. Same is true for automobile. Partner may use his own automobile, claim CCA. Again, you're entitled to 7/107ths of your CCA costs or 7/107ths of your lease expenses, where you're not seeking reimbursement from your firm for your automobile costs, because that was the portion that was attributable to GST. So you will get, to the extent you deduct your automobile for business use, to that extent you'll get a GST credit again when you file your return. Now, the third area in terms of registration for lawyers it's not unusual for lawyers to not be in partnership but to share premises. And there are many examples in the City of Toronto and elsewhere where you call a common switchboard, or you go to the same offices or suite of offices, and there are several lawyers there, each practicing on their own, may refer work back and forth because of their various specialties, and they share common expenses, but they are not in partnership. In that case, each of the lawyers would register as a GST registrant, and each would claim their share of their input credits, their share of the GST paid on the common expenses. For example, if you were one of 7 lawyers, or that's a bad example, let's take one of 5 lawyers, and you share your common expenses 1/5 each, and you incur an expense of $100, which you share 1/5 of, your share is $20, and the GST on that was $7 on the total, but it would be $1.40 on the 20, and you would claim an input credit for the $1.40. So each lawyer would register in a common arrangement like that, whereas if you're in partnership, it's the partnership that registers. Now, the other area referred to in the paper is counsel. Many firms have retained counsel, and generally counsel, and I've talked about counsel on pages 14 and top of page 15, counsel will be considered to be engaged in a commercial activity. Consequently, counsel should register under the GST and should collect GST from the firm. And usually counsel get paid monthly or every 2 weeks. And Irene is going to talk about the reporting requirements and frequency of filing. But for example, most counsel earn less than $500,000. Consequently, they would be entitled to file annually, but required to remit quarterly. So they may collect GST monthly, but only have to remit it quarterly. So there's a slight cash flow advantage to counsel. Now, in explaining it to counsel of our firm, they're not too impressed with the advent of being registered. The cash flow advantage for them is equally unimpressive. I did suggest, however, and this was embraced with even less enthusiasm, that if they were prepared to reduce their counsel fee to $30,000 or less, they would qualify as a small registrant and not have to collect GST and register. But as I say, that by then I was being invited to leave the room. Bottom line is, counsel should register under the GST and is required to register and should collect the GST from their respective firms. Associates, however, that are employees do not have to be registered. What they're paid is salary, and when I referred to the lists earlier on, that's not subject to GST, so they need not register. Now, the next area that I discuss is on page 15, management companies. Many practitioners employ the use of management companies for a number of purposes, provision of offices, employees, etc. Management companies will be considered to be providing taxable supplies, even where what they are providing are employees, because what the management company is charging for is not for employment, but the service of making employees available. So that becomes subject to GST. And so the management company, too, will have to be registered. Now, for most lawyers, it's an added complexity, but in terms of an economic impact, it should not be a major one, because any tax collected by the management company and paid by the lawyer or law firm is creditable. So it's another input credit, so it's a wash as far as the law firm is concerned. Now, this is to be contrasted, and I mention it for a matter of interest, this is to be contrasted with anyone providing exempt services. So to the extent, for example, that a lawyer provides an exempt service and incurs a management fee, then you're denied your input credit on that management fee to the management company, which is a problem. Now, doctors, a lot of doctors have set up management companies, usually on advice from lawyers or accountants. Now, however, under the GST, those management fees charged by those management companies will become subject to GST. Most doctors provide exempt medical services, and what they can charge is fixed by a tariff or fee by the government. So now they're going to have a higher cost of doing business. So the management company, which made sense from a tax planning point of view, may make a whole lot less sense. And a lot of thought is now being given, after all these years of putting in place these management companies, how they can be unwound, because in certain circumstances the extra GST cost is not worth the income tax advantage, or the net benefit becomes so low it's not worth the trouble. So I point that out, not so much for your own personal situations, but any of you who have doctors as clients, and most of them provide exempt services. When I say most, for example, plastic surgery, which is totally elective, that's, even though it's a medical service, is taxable. So, and there are some examples of taxable medical services still around, but most medical services will be exempt. Or if you were to make the determination that you're a financial institution because more than 10% of your revenues in any year are attributable to arranging mortgages, and we determine that that's not part of your professional practice or the provision of advice, again, the use of a management services company could have important negative implications to that kind of a practice. Now, the next area of my paper I'm going to discuss is on pages 24 to 26. Retainers. And it's here that another gremlin has crept in, and I'm going to read to you a passage. You notice on the bottom of page 24 we have one little I. The top of page 25 we have and then there's nothing. We pick up with the text. Well, somehow we managed to leave out of there the paragraph, which I think is in my version. Yes, and so I'll just read it to you because it's reasonably short. The first area of retainer I've given is funds deposited in the lawyer's trust account to be applied against services performed against a specified time period, or with respect to specified transaction, with any excess to be returned to the client. The second category is as follows, and I'll go over it slowly. Funds paid to a lawyer for services performed during a specified period, regardless of the actual services performed during that period. Some retainers fit into that category, particularly in the case of corporate clients. You accept a retainer of X dollars. Now, I understand this is more prevalent in the U.S. than it is in Canada, but nevertheless, we do run into it in Canada. You accept a retainer for a specified amount to provide services, and that's the fee, regardless of how many services you provide in the period. Now,
Repeat that point.
repeat it? Okay. Funds paid to a lawyer for services performed during a specified period, regardless of the level or amount of actual services performed during the period. So it's a fixed fee retainer, basically. X dollars for the next 6 months, and you're available to provide legal services on an as-when required basis. Okay? Now, there's a basic rule in the GST legislation that when payment is received, even in advance of GST, advance of the service being provided, the GST is due and collected. There's an exception to that rule found in 168 subsection 9 for deposits, whether the deposit is refundable or not. And the basic rule there is that there are no GST implications for deposits until they're applied to the service being provided. And then just to complete the circle, there's a special rule later on in the legislation which says that when a deposit is forfeited, it is subjected to GST at that time. Now, the question then becomes, what are my responsibilities when I accept a retainer? Is it a true deposit or a deposit such that I do not have to remit GST on that until I apply it to the services being performed? Or must I worry about GST at the time I receive the retainer? As a general rule, most retainers are going to fall into the deposit category. And consequently, no GST until you apply the deposit. And I assume that trust accounts work the same for most lawyers as the trust accounts that I'm familiar with at our firm. You take an amount, it goes into what we call a trust account. It's not really a trust in the true sense, in that we don't file tax returns on those trust accounts and report income. But certain trust accounts we do, but certain trust accounts we don't. Now, the general trust account, which what I'm calling a trust account, the funds are deposited and the interest goes to the Law Society. So the lawyer doesn't get the interest, the Law Society gets the benefit of it. And then at some point in time you render a bill for services performed. And you spell out the basis of your fee, and then you deduct from that, you apply to that fee trust monies received. And sometimes that leaves a balance due, and sometimes that leaves a balance that you return. Or it leaves, there's still monies left in the trust account. It's only at that time that we would have to worry about remitting GST. And so it's in that reporting period. However, as a practical matter, you may wish to add 7% to the amounts of your retainers, because at such time as you go to apply it to your fee, of course, you're going to have to add GST to your bill. So there may be a cash flow advantage. You would obviously want to take advantage of that. And as a practical matter, too, it's sometimes easier at the time you get the retainer to get the GST portion as well. I know in providing advice to some people who often collect deposits well in advance, they indicate, well, gee, when we go to apply it, if we haven't collected the GST at the time and we send another bill for the GST, it may be sometime in coming, if ever. So depending upon the nature of the client and the work, it's probably good practice to collect the GST on the retainer up front, and that, depending upon how you treat retainers, whether you put them in your trust accounts, etc., that would depend on the GST implications. Now, the second category, which is discussed at the bottom of page 25, it again discusses as to whether the amount is put into a trust account. Generally speaking, it's been my experience that retainers that fall into the second category are brought into income right away and are treated as professional fees. And in that case, the GST is collectible then and there, as opposed to when you perform the work. Again, though, it depends on what you do with that retainer. If you If at the time you render your bill later on, you show some sort of application of the retainer collected, then it's probably more akin to a deposit, and you need not worry about remitting GST that you've collected until such time as you do apply it to your fee. Now, the next area I'm going to refer to, and only briefly, are the transition rules. They're discussed at pages 32 through 37, but the one rule I'm going to mention is the transition rule in the case of services and timeliness of billing. Basic rule under the GST is that if the service is provided after 1990, then it's subject to GST even if you were paid for it in advance. Now there's some exceptions, and I talk about those in the paper, but as a general rule, even if you, for example, if you issue a bill today for services to be performed in February of 1991, it will nevertheless become subject to GST in 1991 when the GST gets adopted. There may be situations, however, where you've performed the work prior to 1991 and you haven't yet billed for it. General rule is that it will nevertheless be taxable if billed in 1991. However, there's an exception, providing the amount becomes due prior to May 1st, 1991. So if you bill prior to May 1st, 1991, even if you don't get paid prior to May 1st, 1991, and the service was performed prior to 1990, there'll be no GST. So WIP, or work in progress, which is on hand on December 31st, 1990, you should make sure, it's good business practice anyway, but now there are GST implications that you should bill that in a timely manner. And in the case of GST, timely means May 1st, prior to May 1st. Now, who will that be important for? Again, for your business clients, really isn't going to matter, because any tax they pay to you is going to increase their eligibility for input credits and reduce what they remit. Doesn't increase the tax that's paid in the new system. They'll get an input credit for it. And so businesses generally won't care. Who will care? Individuals who can't claim input credits, charities, nonprofits who only get rebate for 50%, anyone in the MUSH sector, municipalities, universities, schools, hospitals, any non-residents whom you're required to collect GST from because, for example, your advice related to real property in Canada or it related to the delivery of goods in Canada. So in any of those cases, it is important that you render your account prior to May the 1st, otherwise GST will apply even though the work was performed prior to 1991. Now the final area I'm going to discuss, and I'm sure Irene will get into this a little bit too, and we may get into it in the question period, and that is draft accounts or phantom accounts, and that's on page 22 and discussed on page 23 and 24 as well. And the reason why I've included that in there is that I was shared a panel with an English practitioner in Alberta of all places, and they didn't shoot the messenger even though they don't believe in GST. We spoke to the Alberta Midwinter meeting on GST and legal services. And the English practitioner mentioned a practice that they follow in England, and it has a cash flow implication. As you'll understand from reading the papers and from Irene's talk, GST is payable at the time the amount becomes due. And under the rules, due means issuing the invoice, even if you say on the invoice it's not due for 2 months. issue an invoice today, payable 2 months from now, and Irene will track through these rules in greater detail. It's nevertheless due then and there, whether you're paid or not. So businesses are going to finance the GST to the extent of the difference between the amounts collected and the amounts paid. The remittance obligation is at the end of the month following the month. So if you render a bill in the month of January, you must pay in the GST by the end of February, whether you've been paid then or not. Now you reduce what you remit by your input credits because you only remit the difference. So you're going to finance the GST until you're paid. Well, in England, they don't think much of that, lawyers, and so they've developed what they call a draft account. And they send this VAT invoice or draft account to the client saying, when we're ready to bill you, this is what the bill's going to look like, and this is how much it is, and this is what the VAT is. And we will bill you when you pay us. And until you pay us, we won't bill you. So you won't get an input credit because you haven't been billed. We don't have to pay the tax. Now we have a general anti-avoidance rule in our legislation. It's virtually identical to the general anti-avoidance rule under the Income Tax Act. And we haven't yet mentioned this practice to Revenue Canada, or at least I don't think they're aware of it. It's not something we wanted to go and ask them about right away. We had other things on our list. So I'm not really sure whether this will work or not, but I pass it on for what it's worth. It does work in England, apparently, and the English revenue authorities are aware of it and don't find it offensive. Now, the area of bad debts is also mentioned in the paper, and there's no reserve for doubtful debts, but once a debt goes bad, you do get reimbursed for the GST on that. Now the problem, and that's discussed on pages 26 and 27. Now the problem is, if you render a bill for $100 and then you add 7% GST, and the client says, well, that's nice, but I'm only paying you $100 because I don't believe in the GST. Let's say it's an Alberta client, and they refuse to pay. Well, under the legislation, you're deemed, the $100 is deemed to include GST, so what you would remit, you would be obliged to remit $7, but then you would get, when you write off the $7 as a bad debt, then you get an input credit of 7/107ths of 7. So $100 is deemed to include 7/107ths of GST. So you get, I guess, 49-cent relief on the $7, which is not major, but it's some. There are other areas and topics discussed in the paper. They're there for you to refer to. And during question period, I'm happy to answer questions, but that pretty well concludes my remarks. After Irene's presentation, there are some case studies which were handed out, which we can speak to, because it illustrates some of these rules that we've been talking about. Thank you.
Thank you very much, Tom. Before we break for coffee, I'd just like to go through a quick summary of some of the points coming out of Tom's paper, and perhaps this will be a memory aid to those of you who are here with us today. Just very quickly, as a law firm, you'll pay tax at the time of purchase on inputs, that is property and services purchased for business use. You will charge tax on your fees. This includes fees to legal aid plans, which will be taxable with a full rebate to the legal aid plan itself. You will deduct the taxes paid on your inputs from the tax you collected on your fees at the time you remit the tax. So effectively, you'll recover the tax on your inputs by deducting that tax from the tax you collect on the fees that you charge. You can make a mistake if you don't recover that input tax credit. Effectively, you will have paid more than the 7% tax. So it is possible, in fact, to overpay this tax. But the way, if everything works the way it should work, effectively, it's a pass-through tax. You pay the tax on your purchases and recover that tax by collecting tax from your clients and deducting the tax on purchases from the tax collected on your fees. You pay no tax on wages and salaries paid to associates. You pay no tax on financial services. You, generally speaking, just as a rule, in the case of the council that Tom described, where you acquire something on a fees for services basis, including council fees or fees from another firm or fees from an accounting firm, you will pay tax on those fees. And so they will be taxed as an input, and you'll be able to recover that tax through the input tax credit system. On the other side, on the client side, business clients, other than those who make exempt supplies, will get a full input tax credit. So as Tom has said several times in his paper, they will generally be indifferent and in fact welcome the fact that you are charging them tax, because to those who are aware of the technicality of the system, because your supply to them is taxable, it means that you are getting a full recovery of the tax you paid on the overheads and other inputs used in your business, which means that that tax will wash out of your fees. If you were unable to recover that tax, then presumably, eventually, you would have to increase your fees to cover off the additional cost of the tax on your inputs. So commercial clients are going to be familiar with the input tax credit system, and they're going to be expecting to see tax on your accounts. Consumers and other clients who are not engaged in a commercial activity will not get a full input tax credit. In fact, they'll get no input tax credit, and you can expect they will not welcome the tax on your accounts, and that's going to make it somewhat difficult in the personal services area and the residential real estate area in collecting fees. Tom dealt with the disbursement rule and the importance of agency in claiming a disbursement as a pass-through amount to the client. He dealt with the deposit rule and its effect on retainers. Emphasized it's a timing rule, meaning that what the deposit rule does is delay the payment of tax until the deposit is applied to the fee for your services, but it doesn't change the general principle that legal services are taxable. Quickly, if you're engaged in financial services, I think the message coming through from Tom's paper is get some professional advice. I mean, if in fact you have a mortgage broker operation, and we didn't deal with all of the variations as to whether it's separately incorporated or whether it's being run as part of your law practice. If you have a substantial portion of your practice in financial services, I think you're going to want to seek advice in that area. Trustees' fees taxable, directorships exempt, essentially on the same rule that exempts wages and salaries because it's an office or employment relationship. Registration, partnerships register, partners do not register. In effect, as an individual partner in a partnership, you have no status in effect as being a person carrying on business. You are a partner in the partnership, but are not thereby a taxpayer. However, there's a special rule, which Tom mentioned, which allows you to claim a special rebate of taxes that you pay on expenses that you incur, to the extent that you can deduct those expenses for income tax purposes. So, for example, on your automobile, if you were able to claim a portion of the capital cost allowance as an expense incurred in your law practice, as a partner in a firm, you will be able to get that tax back, not through the input tax credit system. So you're not engaged in filing returns and claiming input tax credits. You'll file a special form with your income tax return for the year. So Tom mentioned shared premises, the relationship of counsel to a firm, the treatment of management companies, and finally, and I want to emphasize the transitional rule dealing with services substantially performed before 1991. And the message I took from it was bill it, because it would seem that a commercial business will be indifferent, since they'll claim they'll either have no tax, in which case there'll be no tax on the service and they won't be claiming an input tax credit, or if there is tax on it, they'll claim an input tax credit. So you simply bill that WIP. And on the consumer side, there's the possibility of avoiding the goods and services tax on services substantially performed before 1991 by billing them before May of 91. So the plan now is to break for coffee, and we'll return with Irene David, who will speak to us on the systems problems in the goods and services tax. Thank you. Should we take 10 minutes, please?